Stop trusting the number on your screen. The real silver price isn't flashing in New York. It's screaming from Asia, and the gap between the two is tearing the market apart. Stop staring at the spot quote on your phone and thinking you understand what's happening. That flashing number is not reality, it's a shadow. If you're watching silver trade in New York right now, you are watching a derivative illusion, a paper echo of a market that is losing contact with the physical world. The green candles look exciting. The sudden dollar spikes feel meaningful. But what you are seeing is not price discovery, it's price delay. The true signal is not coming from the west, it's coming from the east. Thousands of miles away, the physical silver market in China is trading at a level that converts to roughly $80 an ounce once you account for delivery costs and real-world premiums. That gap, $5 or more between paper silver and physical silver, is not noise. In global finance, even a few cents matter. A $5 divergence is a system failure. It means the machinery that normally keeps prices aligned has seized up. Metal is moving in one direction only, and the price on Western screens is being dragged behind it. This is not a normal trading week. It's the final week of December, the period professionals quietly refer to as Ghost Week. The markets are technically open, but the humans are gone. Senior traders are on holiday. Risk managers are offline. Decision makers are absent. What remains are skeleton crews and autonomous algorithms operating in an environment with almost no liquidity. When markets lose depth, even small orders create outsized moves. The pool is shallow. Every splash matters. That's why what we're seeing now is so dangerous and so revealing. A single aggressive buyer can move silver several dollars in minutes, not because demand is extraordinary, but because supply on the screen has vanished. Sellers aren't showing up. Banks aren't absorbing flow. The price jumps because there is nothing to stop it. This is not speculation. It is vacuum behavior. Earlier today, a large buy order pushed silver up nearly $3 in a straight line. No pullbacks, no hesitation. Just a vertical move. That doesn't happen in a healthy, liquid market. It happens when the order book is empty. The banks that normally defend price levels were nowhere to be found. With no resistance, the price simply teleported higher. This is the defining characteristic of Ghost Week. When motivated capital enters the market, whether from industrial buyers, sovereign interests, or funds under pressure, it meets no opposition. Prices don't grind higher, they gap. And the most unsettling part is that the buying pressure hasn't eased. Algorithms see the absence of sellers and rush to reposition before liquidity disappears entirely. This is how melt-ups begin. But why now? Why immediately after Christmas? Why the urgency? Because while Western markets were closed or barely functioning, China was fully active. And in China, the panic is visible. Solar manufacturers are racing to secure silver paste before year-end. Battery producers are hoarding inventory. Electronic supply chains are locking in material at any cost. This demand surge pushed the Shanghai silver price sharply higher. When you convert that price into dollars and adjust for taxes, delivery, and street-level premiums, the real cost to obtain silver in China exceeds $80 an ounce. Now compare that to the price in New York hovering in the mid-70s. That difference creates a powerful arbitrage incentive. Buy silver in the West. Ship it east. Capture the spread. This trade is risk-free as long as the price gap exists, and it is acting like a vacuum cleaner, pulling physical silver out of Western vaults and onto planes headed for Asia. This flow creates an immediate shortage where the metal is leaving, inventories thin, availability drops, and when supply tightens, price must rise to either destroy demand or attract new supply. At $75, the drain doesn't stop. At $78, it might slow. At $80, it finally stabilizes. That's why the paper price has no choice but to chase the physical price higher. The market is attempting to heal itself through repricing. This is what a broken market looks like. A quoted price that suggests calm stability paired with a global spread that screams distress. The price is not reflecting reality, it's lagging it. Look at the retail market in the United States and the illusion becomes obvious. Try to buy silver at the quoted spot price. You can't. Dealers are either out of stock, pushing delivery weeks into the future, or charging prices that imply silver is already well above $80. This isn't greed. It's fear. Dealers are terrified of replacement cost. If they sell metal today and the price gap's higher tomorrow, they can't restock without taking losses. In an environment this volatile, spreads widen dramatically. The message from dealers is simple: we don't want to sell. That's a liquidity crisis, not just in paper contracts, but in physical metal. When sellers disappear at every level of the supply chain, miners, refiners, dealers, you get vertical price behavior, and that's exactly what the chart is starting to show. Now add options dynamics to the mix. Silver is hovering just below a major strike level around $75. At that level, banks have sold enormous volumes of call options. As price approaches that strike, those positions flip into negative gamma. To hedge, banks are forced to buy futures as price rises. The higher silver goes, the more they must buy. This creates a feedback loop. In a normal market, human traders would step in and sell into that buying pressure, slowing the move. During Ghost Week, those humans are gone. Algorithms end up chasing each other higher. If that gamma wall breaks in a thin market, the move from 75 to 80 doesn't take days, it can take minutes. That said, thin markets cut both ways. A single large sell order can cause a sudden plunge. These engineered drops are designed to trigger stop losses and flush leverage. They feel terrifying, but they are not fundamental. They are structural. If you see a violent dip, it does not change the underlying reality. The physical market in Asia is still paying far more for silver than the paper market in the West. Zoom out and look at the industrial picture. This isn't speculative demand, this is necessity. Electric vehicles, solar panels, advanced batteries, none of these industries function without silver. If production lines stop, the cost is astronomical. Paying $5 or $10 more per ounce is irrelevant compared to the cost of shutdowns. Industrial buyers are forced buyers. They don't care about charts. They care about survival. This is why the price feels buoyant. Every dip is met with real, world demand. Industrial hands are underneath the market, catching it whenever it falls. That creates a concrete floor. Now consider the miners. You might expect them to rush supply to market at these prices, but they aren't. Costs are rising across the board: energy, labor, taxes. Political risk is increasing, and most silver isn't mined directly. It's a byproduct of other metals. Miners can't simply turn on more silver production without increasing output of metals the world doesn't necessarily need more of. Some producers are choosing to wait. They see momentum, they see shortages. Why sell today at 75 when next month could bring triple digits? This creates a supply strike layered on top of an already tight market. As we approach the end of the year, another force comes into play: institutional allocation. Funds look at annual performance tables. Silver sits near the top. In early January, fresh capital enters the market as pensions and asset managers rebalance. Billions of dollars flow into what worked. Silver is a tiny market. It cannot absorb that capital without repricing dramatically higher. And while silver grabs headlines, gold is quietly confirming the move. Trading near historic highs, gold acts as the anchor. When you measure silver not in dollars but against gold, it remains historically cheap. The gold to silver ratio is still elevated compared to past peaks. That tells large players there is more upside ahead. This isn't about liking silver. It's about math, relative value, structural scarcity. Meanwhile, trust in paper promises continues to erode. Debt levels are unsustainable. Bond markets are cracking. Fiat currencies are being diluted to service obligations that can never be repaid in real terms. Capital is fleeing paper claims and moving into tangible assets. If even a small fraction of global bond capital seeks refuge in silver, the market must expand dramatically. Price is the only mechanism that allows that expansion. This is not a trade, it's a transfer. And it's not driven by fear, it's driven by arithmetic. Higher prices are not suppressing demand, they are attracting it. In a currency crisis, rising prices signal safety, not excess. People want out of depreciating money and into something real. Silver becomes not just a metal, but a statement. Proof that you exited the system before it failed. We are nowhere near the mania phase. When everyday conversations revolve around silver, that's the top. Right now, the conversation is still dominated by inflation, fuel costs, and market confusion. This move is early. There are risks. Exchanges can raise margins. Trading can be halted. Volatility will be extreme. But those actions do not fix shortages. They expose them. Halting a market does not eliminate demand. It pushes it elsewhere. If official prices freeze, unofficial prices explode. The key is positioning. Leverage is deadly in environments like this. Thin liquidity hunts margin. Physical metal does not care about intraday swings. It cannot be liquidated by an algorithm. Ownership matters more now than at any point in decades. As we move toward the new year, the direction is clear. Watch Asia. Watch physical premiums. Watch inventory, not headlines. The paper price will follow reality eventually. It has no alternative. The spread between Shanghai and New York is the message. $80 is not speculation. It's discovery in progress. This is what a system looks like when it loses control of the narrative. For 40 years, price was suppressed by leverage and confidence in paper claims. That confidence is breaking. The beach ball is rising, and once it breaks the surface, it doesn't politely stop. This is not the end of the move. It's the beginning of it. Hold steady. Ignore the noise. The liquidity crisis has already started, and it doesn't resolve quietly.